Hey Dave, how you doing? Is to partner with excellent operators in excellent markets. The way to find deals currently is to be entrenched in a market, know it well, know the brokers. In this, be able to find deals either on market, off market, ideally off market. So that's really, I've gravitated towards partnering with operators like OKIQ, and very happy to have found them. And Because they're just that, they're that operator. They're entrenched in Kansas City. They've got a lot of properties there. They've had very successful syndications. So that's kind of the journey for me personally, was from operating properties myself, and at least on the short term, really putting my efforts right now into partnering and bringing investors to deals with the best operators. So, Caleb, let me kick it over to you. Anything you want to add to that?
Oh, I appreciate that, Tom. I appreciate you assembling this group of great people together, and I know there's a number of other folks that are coming in that were invited to this, and it's really a pleasure and a joy to be able to share with you guys this evening. I'll bring up a presentation in just a moment, kind of highlighting our overall investment thesis and approach, some of the unique advantages that our team brings to this, syndicated real estate investment space. But just kind of to start, my personal background, I started a landscaping company when I was 11 years old. I did that to help my mom, who was struggling financially. Her and my dad had recently separated, and I felt the burden to help. And so I figured out how to fix a push lawnmower that was in my shed back in North Carolina, and repaired that, and hung a handwritten flyer up on a local gas station. And I didn't even ask permission. I just did it, and I got away with it, I suppose, and got my first 3 clients within a week. And by a year from that, I had a full enough client list where I had to hire 2 of my buddies as employees. And lo and behold, I ended up building that business all the way up till age 26. We were a multi-market, multi-crew, full-service landscaping company that served Western North Carolina and upstate South Carolina. And now I live in Kansas City, lived here for about 13 years. The way I got into real estate in the first place was in North Carolina, similar to East Tennessee, and where Tom is, it gets cold enough for grass and hedges to stop growing, but not quite cold enough to have a lot of snow removal work. And so I had to find something to do for my crews to do during the colder months. And so I decided, when 45 days after my 18th birthday, to buy a fix and flip, talk my dad into co-signing on a loan. And I had the cash, I just didn't have the credit. And so I, bought that fix and flip, ended up having my crews renovate a small 3-bedroom house, was able to pay them for 4 months and make about $13,000, before I turned 19. So that was fun. $13,000 on a single deal was pretty good for an 18-year-old who didn't have a clue what he was doing. But that's how I got bit by the real estate bug. And have been invested in real estate in various capacities ever since. I've also, built several other types, businesses, and spent about 10 years in nonprofit missions work after exiting my business at age 26, kind of to focus on purpose rather than profit. But I tell people, you can take the boy out of business, but you can't take the business out of the boy. So I was always finding ways to scratch the entrepreneurial itch, including investing in real estate, as well as doing quite a few other ventures. And so that's kind of my background. I joined OKIQ as a partner back in 2022. OKIQ is an established firm that was founded by my business partner, Aaron Leatherdale. Aaron's been a real estate investor since he was 22, up in Canada. He built about a portfolio of about 18 units up there, and then sold those and can continue to roll those up here in Kansas City up until buying his first apartment complex, then kind of founded Oak IQ as a way to really manage his own personal investments at first, primarily on the operations side. So our background at Oak IQ is we're operators first. We don't just curate investment opportunities. We actually run the deal with our whole team, right? We've got internal asset management. Down here in the hall at our offices here in Kansas City is our our in-house construction company that self-fulfills all of our renovations and things like that. Right across the hall here is Brad Grizzle's office. He's our senior asset manager. Aaron's office is right behind mine. So we've got the full team, and we run the full deal from top to bottom. And so it gives investors a lot of confidence being able to come in either as a group and, with, guys like Tom, to know that you have the opportunity to interact with not only the person who's doing the investment side, but the person who's actually running the deal on the ground. And so I'm going to share a little bit here. I'm going to share my screen. So give me just a second. There we go. Like I said, we're Oak IQ Investments. Just a quick disclaimer. Everything I'm going to talk about and share is for educational purposes. I will share about an opportunity, and if whoever invited you to this call, whether it was Tom or somebody else, you can have a conversation with them after this call about whether this is the right opportunity for you to consider investing in. Would love to have you. There is limited space in the offer I'm going to share, so just know that going into this. But just want to make it clear that before investing, official offer will be made through a private placement offering memorandum. This is not an official offer to buy or sell securities or anything like that. This is for education and overview of Oak IQ and one of the opportunities that we currently have. So why Oak IQ? Why the name Oak IQ? Well, an oak tree represents strength, longevity, generational growth, and IQ represents intelligence and innovation. So we specialize in bringing innovative and intelligent approaches to asset classes like multifamily that have proven strength, longevity, growth, and stability, so that investors have the opportunity to get the best of both worlds. A little bit of our track record. We've got now to date about 170 million in assets under management. We have full cycle investment experience, with our full cycle investments averaging a little over 30% net to investors IRR. We've never lost an investor dollar on a deal, and we've never had to do a capital call. And a lot of that success that we've been able to have in this industry is in large part to what I call the MAST filter, or the MAST framework. Every deal and opportunity that we look to invest in has to pass a very strict criteria of market analysis, data analysis, and then determining from that market analysis what's the correct and smart and intelligent approach to take to capitalize on what the market's telling us. The S is the squad. We are firm believers that the team is more important than the deal. I've seen a lot of deals that look really good on paper but go south because of less than optimal teams. And I've also seen deals that are somewhat mediocre on paper, but they end up going really well because of really great teams. So I think, before you're investing in an asset, you're investing in a team. And so we focus a lot on assembling the right team for each opportunity. And then the last thing is the terms. We want to make sure that every single opportunity that we present to investors, one is an investment that is an opportunity that we personally are excited about investing in. We invest our own capital and our own money in every single deal that we put together. We're the first money in and the last money out in most cases. And so investors can feel confident that there's an alignment of interest across the board. If you win, we win. If you lose, we lose. That's just how we like it. And, our MAST framework, what is it currently telling us? Well, it's telling us there's a prime window that's open for Kansas City multifamily investing. Now, before I kind of go into why I make that bold claim, I want to give you a little bit of background behind the MAST framework and the genesis of the MAST framework, if you will, and kind of where this came from. I'm a big fan of the economist Thomas Sowell. He's the acclaimed protege of Nobel Prize winning economist Milton Friedman. He's a senior fellow at the Hoover Institute and Stanford University. I've read just about all his books, and I love his definition of economics. Thomas Sowell's definition of economics is that economics is the study of scarce resources which have alternative uses. So if you think of that, if you spend $1 on a candy bar, that's $1 you can't spend on something else. And economics is the study of the flow of money, scarce resources which have alternative uses. And the first lesson of economics, according to Thomas Sowell, is there's never enough of anything to fully satisfy all of those who want it. Now, when you're looking at public market investing, which is what I spent about 5 years trading in the stock market, I actually did really well. I had a year where I had 119% return across my portfolio. I was riding high, feeling good about it until a personal family crisis involving my son took my hands off the wheel of my trading platform for about 4.5 months, and I lost 40% in the stock market in 4.5 months. But it was very active, very hands-on. It's a big part of why I reallocated a larger portion of my personal portfolio into real estate and other syndicated alternative investments. But it really comes down, my thesis behind stock trading, and when I was doing that and had the success that I had there, the thesis behind that is also a very harsh reality, and that's this: stock values are determined by the supply and demand of the stock itself, not the supply and demand of the underlying products or services that the company provides. Public perception is ultimately what creates volatility and not fundamentals. So if you look at, I just saw Amazon's Q1 earnings report, and it's one of the best Q1 earnings reports they've ever had. And yet over the last 30 days, their stock's lost about 12% of its value. And the reason behind that is everybody's freaking out about tariffs and economic uncertainty, and it's understandable. But the reality is that you can have a company that's doing really well at a fundamental level, and you can still lose money if you're invested in that company, because the value is tied more to the supply and demand of a paper asset than a hard asset. And if people get scared in a highly liquid investment, they can sell that off and it drives values down. And worse than that, you've got large institutions with billions of dollars of mostly your money that can rig the game in their favor. If they want values to come down so they can buy low, then they can dump their shares and rebuy them and short the losses. And so they win on the losses and the gains. And what I did in the stock market was I got pretty good at technically analyzing charts to be able to see and accurately predict within a certain margin of error what those larger institutions were going to do and try to match my trades with theirs. And it was a very successful strategy, but it was very, very analysis intensive. But to give you an example of how these institutions do this and basically harvest and take money out of the pockets of everyday investors like you and I in the stock market, Goldman Sachs back in 2010 set a record for $100 million trading days. That's profiting $100 million a day for 131 consecutive trading days. And that they beat their record in 2010 that was set back in 2008 in the economic crisis, where they had 90 consecutive days of over $100 million profit on the trading floor. And I don't know anybody who had 90 days profit in 2008 on their stock market trades. But because these larger institutions play with such volume, they can game the market in their favor. Now, the way that I traded in the stock market was I would batch my trades in groups of 4. And the reason was, if I did that and I used a 3-to-1 reward to risk ratio, then I only had to be right half the time in order to be net positive profiting. So I got an example here on the screen. If I had 2 picks that won, it was plus $3, just using that as an example, and 2 picks that lost, negative $1, a $3 reward for a $1 risk. I was willing to risk losing $1 on each trade in order to make three. And if I was right half the time, I still was net positive. And the only way I'd lose money is if I was wrong all four times. And the kind of core philosophy behind this was I wanted to look, where was the scarcity? Where was there going to be a supply and demand gap where the anticipated supply of that paper asset was going to be low and the anticipated demand was going to be high. So I would try to match with these institutions because they would artificially create those kind of dynamics so that they could harvest these huge $100 million profit days. So, the concept that I've lived by in the investing world, and it anchors to Thomas Sowell's definition of economics, is if you target scarcity, it has the power to produce abundance. And that's why gold is more valuable, because there's less of it, it's scarce, and toilet paper is less valuable. It's easy to produce and there's lots of it, unless of course you're at Costco during COVID. Now, the first key then to winning in the economy as an investor is being able to accurately project what are the supply and demand trends going to be. And that kind of is the anchor and genesis of the MAST framework, is if we can get to the bottom of supply and demand trends and capitalize on those trends with the best team in the right terms, then we can have a pretty consistent high probability of success. And so the first thing that we look at in MAST is the market. And so I'm going to go through why we're so excited about Kansas City. Yes, it's where we live. Yes, we have the Chiefs. If anybody's from Philadelphia, you can go ahead and get off the call. Just kidding. But want to talk a little bit about the Kansas City market, because it kind of flies under the radar, but it's starting to get a little bit more attention, and there's a reason for that. And I want to break down some of this analysis that we've done has been over the last year, and we just put out our Q1 2025 multifamily market report. And we're seeing everything that we have been saying was true about Kansas City come true, right? Number one rent growth market in the nation right now. And so, just some highlights about the Kansas City area. We're considered the number one best city in the U.S. for remote work. Number 3 cities for growth in the tech industry. Number 3 in the nation for high paying occupations. We're a top 10 city for net migration gains, which means we're getting more people moving in faster than people are moving out and dying. So a little bit about kind of the stability of the Kansas City market. Something we look a lot at is not just job growth, but employment diversity. It's important to have new jobs in a growth market where you're investing. You want to have a good inflow of new high-paying jobs to bolster the local economy, but it's important that those jobs come in various sectors. You think about Detroit, for example, which, right now could be a pretty compelling market. But back in like 08, when the automotive industry, everything got hit hard, I get that. But when the automotive industry got hit, it was something like 50% of the jobs, because there wasn't a lot of employment diversity in that market. Kansas City is considered to be one of the most diverse economies and job markets in the country, with no single sector making up more than 15% of the jobs. And so that creates a good baseline of economic stability. And that's proven in the fact that we were, a top 5 most resilient during the pandemic local economy. When a lot of places got hammered really hard, Kansas City actually was able to weather that kind of black swan event pretty well. Now, when we zoom into right now, and when we think right now is the time for Kansas City multifamily, one of the first statistics and data points that we want to look at is well, what's the supply trend? How much new supply is going to be coming into the market during our hold period, right? Where are the current supply? What's the current supply situation, and how is new supply going to come into the market? Well, right now, we're down 70% over our 10-year average on new apartment starts. That means 70% less apartment units are getting started than they have on average over the last 10 years. We've also seen an absorption rate increase of 50% year over year. And so what that means is more people are moving in, leasing up apartments, while significantly fewer apartments are getting built. And so you can see that supply and demand trend widening, right? And we've already kind of established that the first baseline of winning as an investor in the economy is being able to accurately project supply and demand trends. And so those two statistics alone tell us, well, if there's not any new supply, there's not a lot of new supply that's coming onto the market, and we're seeing a higher absorption rate, which means we're seeing an increase in demand, then we see those supply and demand, trends separating. And that's kind of played out over the last few years, being that year over year from Q1 of 2024 to Q1 of 2025, Kansas City is the #1 year over year rent growth market in the country. We've seen higher rent growth than any other major city in America, with a current total market apartment occupancy of just under 95%, which is really strong. Now, if you look historically, according to the National Multifamily Housing Council, Kansas City needs about 19,000 new units over the next 10 years just to catch up from shortages that were created by the 2008 financial crisis. And since 2010, over the last 15 years, there's only been 16,000 new apartments built. And we're down 70% over the last 10-year average in new starts. So you can begin to see that there's a supply issue that's being staged in the Kansas City market in terms of apartment units. Now, the all-in cost to build apartments in Kansas City ranges right now between $180 to $250 a square foot based on amenities and finishes. Again, according to MMG, the current pipeline is suppressed by more than 50 to 70%. Financial barriers to entry exist due to capital constraints on debt and equity caused by a historic rise in interest rates in 2023. So we saw interest rates go down, to very, very low post-COVID, and then they went up at a historically fast pace. And there's a national, currently in the near term, an excess supply of apartment units, about half a million apartment units nationwide that have been delivered, new apartment units that have not been yet absorbed. Now, that trend is starting to shift nationwide, but it's important to note that because of this, a lot of these new apartments in bigger markets, mostly Sunbelt markets. I know there's a lot of folks from Texas. I'm sure if you're in Austin or Dallas or somewhere like that, you see a lot of new development in multifamily, and a lot of those those operators are struggling to get those places occupied without giving significant rent concessions and things like that. And so there's a lot of distressed new assets, and that's got larger institutional capital, both on the debt and equity side, pretty gun shy on new developments in the near term, which makes it significantly harder for developers to build, even in markets where the supply is needed and there's not that oversupply like Kansas City. Now, nationwide, like I said, there's an excess supply of new apartment deliveries, but a projected national shortage by the end of 2026 or early 2027. Last year, 2024, it was a record new apartment deliveries. 70% of those new apartment deliveries were in 20 metro areas. Were consolidated in 20 metros, and 13 of those were in the Sun Belt. So the vast majority of the new supply is in Sun Belt markets, and there's only one of those metros that's kind of received that high influx of new apartments, and that's Minneapolis-St. Paul. Kansas City has not experienced that issue, and we do need more apartments. And so ultimately, what do all these market factors, if we distill those down to a realistic picture of supply and demand, what does it tell us? Well, there's an existing shortage. there's a 50 to 70% drop off in apartment starts, which means there's a trend of decreasing supply. Um, Projecting out a pretty significant apartment supply shortage that's likely by 2026 or 2027. And so the summary of all of this goes back to, if scarcity has the power to produce abundance, then the current apartment multifamily investing situation in the Kansas City market is that there is existing scarcity and likelihood of a growth in that scarcity, which makes it a really good buying and investing opportunity for long-term growth. Now, that's the market. The second part of our mass framework is the approach. So if we look at that, what is the intelligent play for multifamily then in Kansas City? Well, for us, it's buy distressed, mostly off-market apartment buildings, or build new ones, even though it's hard. And we're focused on doing both of those things. And that ultimately comes down to the idea that currently, with a lot of volatility and stuff like that, and a national multifamily surplus, there's a lot of fear in the market around multifamily nationwide. However, the Oracle of Omaha, Warren Buffett, says that when there's fear in the market, it's time to get greedy, and when there's greed in the market, well, it's time to get fearful. And so we've decided as a firm to go all in on Kansas City multifamily, as well as a couple of other asset classes that we have some data to back. But we were able to acquire a 131 unit multifamily property in Kansas City called Hernhut Apartments. We've rebranded it to the Pines at Red Bridge, and I'm going to tell you the kind of backstory around this apartment building, and kind of share why I'm sharing this one with you guys today. We had basically a 1031 exchange buyer that we were working with that was selling a property up in Seattle area, and had it under contract, all of that, and he had kind of wanted to go into this project as a single investor. We'd been negotiating and working with the seller directly on this asset for several months. The story behind this asset is it was owned by a nonprofit organization that experienced they used it primarily for volunteer and staff housing. That it was exclusively actually volunteer and staff housing. Because of that, they had a property tax exemption. They weren't subject to UBIT tax or anything like that. And they kept it pretty well occupied up until late 2023, when they had a leadership restructure, lost a significant amount of their donor base, and lost a significant amount of their staff and their volunteers. And this asset dropped to about 60% occupancy because they could not go out and market it to general market tenants. If they did, they would lose their property tax exemption. And they're not a property management company. They were a nonprofit organization. So they didn't want to trade new revenue for a new tax bill and still break even, and now have to, manage a bunch of tenants that weren't part of their organization. And so they approached us, wanted us, they were initially wanting to get market for it, $85,000 to $90,000 a door. As is conditioned for an asset of this type. It still would have been a decent deal at that price, but we couldn't justify offering that amount considering the low occupancy. Now we, felt very confident that we could get it leased up pretty quickly because there's a lot of demand in the market. And the reason for the low occupancy was not because of the performance of the asset itself, but because of the unique situation behind the asset. And so, we were able to negotiate and get them to agree to $72,500 a door. So just under $9.5 million total purchase price on this asset. Really, really great deal. We've done a lot of these kind of 70s vintage type Class C value add conversions in the Kansas City market. And we've walked tons of these, maybe 100 of them in Kansas City, maybe not that, but a lot of them. And this is by far the nicest, cleanest asset of its vintage that we've ever walked. It's been very well maintained, no significant deferred capex. The units are actually in pretty good condition. There's some of them that are going to need a more comprehensive renovation. They were used for student housing, and students don't take quite as good care of things as as a lot of other people do. But we were able to get this for a really, really good basis. And that 1031 buyer, well, he was going to come in as a single check writer. So excited about the asset. We were so excited about it. Such a fantastic deal. Very, very difficult to find in the current market a deal like this. 45 days before his scheduled closing, one of his buildings one of his buildings that that he was selling caught on fire. So he had to drop out of contract, and we had about 3 weeks to say, well, we're not gonna lose this asset. It's too good of a deal. And so we put together a fast and dirty capital raise. We're able to raise about 60% of the equity in 3 weeks required to close this deal. And we just put up, got basically a short-term equity bridge to get us to closing. And now kind of what we're doing is we're backfilling basically the remaining $900,000 left in equity on this deal. And so it de-risks it for a lot of investors because there's no fear of, are we going to be able to close? We already own the asset. We've already closed on it. We already have proof of concept. We've got just this past week, we signed, four more leases on unrenovated apartments at our pro forma rents with no renovations at all. So we put no money into those units, and we're getting rent at our pro forma right now in as-is condition, which is huge for investors, that kind of proof of concept. So it really de-risks and demystifies an opportunity like this. You don't really have to guess. There's already a little bit of established track record on this asset, although albeit only a few months. So here's a little clearer picture of the asset. Like I said, it's a multifamily property, 131 units in Kansas City. We got a substantial opportunity to increase value through unit renovations and rent increases. Not only is this asset not in good condition, the apartments that are leased up are currently pretty significantly under market rent because the rent was artificially suppressed because it was primarily by the previous owner used for nonprofit, volunteer, and staff housing. And so we've got a real opportunity to add a substantial amount of value. Here's kind of some pictures of the interior unrenovated units. You guys can see these are very clean, very nice condition for an asset of this vintage. Like I said, purchase price is $9.4 million. We're projecting a 3 to 5 year hold on this with a $4.2 million total equity piece. Like I said, we've got like 900,000 left in space, in available space for this one. It's underwriting a 2.1x equity multiple and a projected IRR of between 16 to 18%. Again, some key reasons why investors are liking this deal is it's an off-market deal. We bought it directly from the seller at a significant discount. It's in a prime South Kansas City location near the Kansas City state line, major Highway 435, and a lot of the top employers like Cerner Corporation, T-Mobile World Headquarters, Honeywell Corporation, some large national brands close by for employment opportunities. We're also implementing accelerated depreciation strategies to boost tax benefits to investors over the first several years of this. And again, attractive return projections. A little bit about our team. Again, I've already introduced myself. My business partner, Aaron, he's the CEO and founder of Oak IQ Investments. Told you a little bit about him. He's been investing in real estate and apartment buildings for the better part of the last 20 years and had a lot of success. I'm the managing partner here at Oak IQ Investments. I've also invested in quite a bit of real estate and have had, a pretty significant amount of success as well. I told you about Brad, our senior asset manager. He's kind of boots on the ground, day-to-day operations, working with our on-site property managers, making sure that the business plan on each asset is going the way that it should. And then we got a couple other partners in this deal, Jesse Tate, Rod Ariola, Wayne Johnson, who's on this call right now. All these guys bring significant experience, both with a real estate investing background as well as, business, entrepreneurial operations type background. They bring a lot of strength to this. We've done a lot of deals like this one. Here's just some of kind of a snapshot of value add type properties that are similar that we've executed this very similar business plan on. Every single one of these assets has either went full cycle and exited, or we are achieving or exceeding our pro forma rent projections on these. And like I said at the beginning of the call, we've never lost money on any of these deals, and we've never had to do a capital call. So a couple more of these here. These are just some of the track record of assets, like kind assets that we've been able to run this same business plan on. So kind of the investment summary here on this one is, we've got a total purchase and project cost of about 12.7 million. That gives us a pretty significant renovation budget of 2.1 million. Now I want to make it clear here, we do not anticipate or even plan on needing to spend that entire renovation budget. We just know that it's better to be overcapitalized than undercapitalized on a deal like this. Like I said, we're leasing up units this week on this asset. We've signed 4 new leases just this week at pro forma with no renovations. We have renovated 12 of the units. They were the ones that were in the worst condition. It was a whole building. It's the first time ever that we've been able to renovate an entire building that didn't have a single tenant in it. Man, it made the renovation so much smoother, not having to work around tenants. But so we were able to get those done quickly and get those on the market. And we're sort of A/B split testing, right? How much more can we get for a fully renovated, modernized unit versus, a clean, made ready, classic unit? And if, and we're just kind of seeing and being very nimble in how we approach it, because we don't want to spend a bunch of money on renovations if it doesn't, create, a significant enough increase above our pro forma rents. So this just, we've taken a lower leverage position, 66% loan to value on our senior debt. That is a fixed rate financing, local bank, 2 years interest only. Obviously already secured. We don't do any deals that don't pencil on fixed rate debt. We've seen too many deals over the last several years get in trouble because of floating rate debt situations. We've been disciplined throughout the entire thing. We always go for fixed rate debt. That just mitigates a lot of that debt risk. And so that's a little bit about sources and uses. The unit information here, current in-place rents, as you can see, are well below, market value. 65 of the 1-bedroom units currently renting for $771. We'll easily get 900 plus. 2 bedrooms renting for about $916. We'll easily get, 11 to 1200 on those. And then 8 of the 3 bedrooms are getting about 1052. We should easily get about 1400 a month on those. And we kind of base that on, comparable properties in the area. What are they getting on a average rent per square foot basis? 2 of these on the comps are ones that we own in the same submarket, and so we know exactly what the rents are, and they are, above the pro forma on that we have set for this project. One of the things that's important is because of low occupancy and the fact that this is a value add play, we don't project any cash flow for the first 2 years to be distributed to investors, but that should kick in year 3. So just know if this is more of a play for upside, a quicker turnaround type deal. We're hoping to get this thing wrapped up, in about 3 years, but we do want investors to feel comfortable with a full 5-year hold period. We just don't want to be forced to sell if the market's not optimal for that. So we've got it modeled on 5 years, but we do hope to get this one turned around and get those returns, harvested quite a bit quicker on this one. So that's the goal. We stress test every deal. We look at, okay, what if there was, even more cap rate expansion? What would this deal look like? We've got this tested all the way to a 6.75% cap rate. And we're still looking at a projected 1.86 equity multiple and about 13.5% IRR in our heavy downside case. And so a lot of risk mitigation on this opportunity. So with that being said, thank you for taking the time to listen. I want to open it up these last, probably got about 15 minutes before we said we'd wrap up here. I just want to open it up for any questions at all that you might have, any interest, any questions that you have on either our overall approach and thesis behind multifamily investment in the Kansas City metro, and specifically on this asset and this opportunity. Just feel free to jump right in.
Yeah, you can, and anyone can put something in the chat if they want to put a question also. But I had a couple questions from investors that couple that have seen some of the materials and weren't able to attend tonight. I
Yep.
guess one was about, you're projecting 3 to 5 year
Mm-hmm.
hold. When did this property close? A couple months ago? Is that what it was?
We closed in December. Yeah, we
Okay,
closed in
December
December, and then
24.
we put up the equity bridge and just kind of slowly been calling in the remainder of the capital. Not in a hurry. We got a couple other opportunities, so we're not in a hurry to get it to get that. But now we're kind of moving in that direction where we just need to get it buttoned up. But yeah, we closed on it in December. Obviously, the first couple of months of ownership, a lot of transitional stuff, and then we acquired it during the low leasing season. So didn't sign a lot of leases, the first couple months, but that's been picking up over the last month.
Got it. Um, The other question I had was related to the CapEx budget, 2.1. You touched on that you probably, you may not need the entire 2.1. Was that mainly interior or did that include, plumbing and electrical of this vintage sometimes can always be a concern. So
No,
what's the story there?
yeah, all the plumbing and the electricals in good condition. We had all that inspected during due diligence. So there's, nothing standing out. There's no, typically on an asset of this vintage, we'd see, a pretty significant amount of wood rot on the siding and things like this. These are, partial brick and then not a lot of wood rot at all. There's maybe a couple of places that, will be very minor repairs. A lot of the HVAC units are newer. I mean, the previous owner, they did a good job of taking care of it. We're getting ready right now to paint the exterior just to give it kind of a nice facelift and give it some better curb appeal, freshen it up a little bit, do some minor landscaping stuff just to kind of impact that first impression on tenants. The first thing we do on any of these assets, these vintage assets, is we go in, we renovate the leasing office and the common areas. It's the first impression. So when a prospective tenant comes in, we want them to, come into a nice new modern leasing space. And so that was the first thing we did, was renovate the leasing office and the kind of the I don't know, community area, where tenants can have birthday parties or whatever by the pool and that kind of stuff. So yeah, but the majority of that renovation budget is $12,500 a unit is what we have on our renovation budget. We do not think that we're going to need all that. Like I said, I mean, we're signing leases at pro forma on unrenovated units that we haven't put a dollar into.
Yeah. And I think, yeah, pro forma, right? That's the rent that they projected that they would get after renovation.
After
And
renovation,
I
yeah.
think everybody understands that, but if there's anybody who didn't understand, catch that, that they projected, oh, we're going to go in and spend 10 to 12 grand on these apartments. We're going to get this X rent, and they're already getting that in some cases without those
Without the
renovations. So
renovation.
that's pretty cool.
Yeah.
And then one other question I had was, are there concessions needed in this market or not at all? Right? I mean, based on the market right now, are any rent concessions in place or in the market?
In terms of with an asset like this being, undervalued, under market rents, we we will typically give some rent concessions if we have for example, if we have an existing tenant, once we get to the point where we're non-renewing, so we can get in occupied units and do a renovation or make ready on those to try to get those rents up. We'll typically offer, if it's a good tenant, they're a paying tenant, they're responsible, they take good care of their unit, we'll go to them first and offer them a newer, renovated, nicer unit. And we'll typically, year one, we might give them a $50 to $100 discount or something like that, just so we can keep that solid tenant, because we have, a track record with that tenant. We know that they're a good, solid paying tenant and they take good care of it. So that's usually, our first step is to try to move existing tenants from classic units into the more renovated units. But in this case, like I said, we may not end up needing to renovate all the units because of it being in such good, clean condition as is. So that would be the only scenario where I would see, any real kind of concessions. But we've got a lot of that modeled in and built in. What
So,
other questions we got? I think Brad looks like you came off mute. What you got,
yeah,
man?
what's the minimum investment you're looking for on this? You said you had 900 total, 900,000 total.
Yeah, so Tom's putting together a group to come in, and he's going to kind of determine, what he's going to, set sort of as his group investment minimum. But for us directly, it's $100,000 minimum to come into this one. I don't know what Tom or some of these other guys that are bringing groups together, what they're gonna do. But for us, the 100,000, by putting together a group, Tom's actually getting some preferred terms, which actually make it even a little better deal for investors. So it's smarter to go in with Tom than it would be to go directly with us to get a better outcome. So
Yeah, so that's a good question, Brad. I mean, the upfront story really that we've been going with is 100,000 is our minimum, but that is I'm certainly willing to talk about that. If that's kind of the approach that we try to take, since that's what's being set by the operating group, Oak, and but that's definitely up for discussion. So yeah, I think probably the main purpose of this call was to introduce Oak IQ, introduce this deal particularly, and we're very excited about raising for this deal. And also just, I think a lot of folks on this call, weren't totally familiar with the types of deals that I've been involved in. And so I just really wanted to get that out there. Hopefully, we can get some interest on this deal. I think it's an amazing deal for a lot of the reasons you heard. It's a very interesting story. That's one thing about real estate. There's always interesting stories. This one's got a very interesting story. So anyway, yeah, I think that's up for discussion, but that sort of range, say 50 to 100 grand would be a minimum right there.
Thank you.
Yep. Looks like Alan came off mute. I don't know, Alan, you got a question?
Yeah, I just had a couple of questions, just kind of I'm sorry, I got my camera set up funny. How about like parking? It looks like there's pretty good parking, but how much parking per unit? And I'm curious where you've got multi-bedroom, 2-3 bedroom, are they all one bath units? And are there any other amenities, tennis, pool, that kind of stuff?
Yeah. Yeah. So in terms of parking, I don't know the exact parking ratio. There's definitely more, there's, I don't know the exact number of parking spaces off the top of my head, just being totally honest with you. I could go down, it's about 1.5 miles down the road from our office. So I could go down there and count them for you real quick.
More than one per unit, I assume.
Yes,
1.5.
yes, absolutely. There's plenty of parking. I mean, this asset for years was pretty much fully occupied, 98%, with the nonprofit organization. And so it's, plenty of parking. There's a pool, on-site pool with a kind of a common area where people can do, events, parties, that kind of stuff. There is space in the back where we have considered, if it ends up being a good, value add, if it ends up, adding value to it, there's a space in the back where we could put and pour like a pickleball court. We've not made that decision whether we would do that or not. It's just kind of been a conversation we've had. We thought, we don't want to just do it because it'd be cool to do it, but if we were able to do the research and find that it would add value. Yeah, so that's kind of, and then, yeah, all the units are one bedroom or one bathroom, and it's a blend between 1-and-1s, 2-and-1s, and 3-and-1s.
Okay, thanks.
Yep.
Are you sure about that? Because I'm looking at the rent roll and it's got on there 2 2s, 2 1.5s. It looks like there's a pretty good mix, Caleb, on the 2 bedrooms. I'm showing just on the. I just was kind of filtered on the rent roll, so I think it's actually a little better than that. Let's see. I show 16 2 1.5s. We've got 16 2 2s is what it says in the rent roll, and then 28 2 1s of the 2 bedrooms. So that's better, really.
Yeah. Yeah, I'd have to go in and see that, but if you're looking at the rent roll,
Yeah,
then
I'm just looking at the rent roll here. I pulled
yeah.
it up, so it looks like that's a pretty good mix.
Oh yeah, there are a smaller amount. Looks like a total of about 24 that have that are more than one bath.
Yeah, because that's in this day and age. And then what about wash? Are there any washer dryer hookups, or what about with regard to washer dryers? Is that something they use
No, there's not. There are
laundry
no
rooms?
in units. So there's washer dryers in the common areas of each building. Yeah,
Yeah,
to paid coin
perfect.
laundry. Tim asked, who manages the property? Did I miss something? You got to forgive me, Tim, a little bit. It is the end of the day, and if you saw my calendar today, it's my brain is pretty fried. But we have an on-site property manager that works on site, and our asset manager Brad kind of manages that property manager. So yeah, we do manage the asset, but that's not the day-to-day operations is not my side of the business.
And I would like to say that Caleb did have to uh, reschedule a date with his daughter for tonight. I think to make
I'm
this
taking her
call.
out
So
tomorrow. I'm taking her out tomorrow night. I usually
we
take her out on
appreciate
Tuesday
that.
nights. Yeah.
Well,
What else we
Caleb, I
got? We got a
appreciate.
couple more minutes here. Anybody else got any questions?
Yeah, I got I guess one other quick question, and it's
Mhm.
probably just because I don't understand the figures, but your pro forma rent, that's kind of your target rent
Mhm.
today, correct? I mean, if you could rent today, you would like to obtain that pro forma rent rate.
Well, actually, that the pro forma rent is based on renovated market comp. So if we, that's once we, renovate the units or make ready the units, then that's our kind of projected rent that we'll be
Okay.
able to achieve. And that's kind of one of the unique factors of this is we're actually achieving those projected rents on leases without doing the renovations right now on some of those units. So that obviously is a positive trend and kind of build some confidence for our investors because we're not having to spend $12,500 on a unit to achieve those rents.
And how do you handle like rent increases? Are they typically annual? Do you just kind of typically go through an annual rent increase? Do you follow the market? Do you take into
Yeah,
account?
we keep a close pulse on the market, but when it comes to underwriting, we use a pretty conservative assumption of 3% annual rent growth each year. And we tie that to growth and expense as well. So we anticipate that expenses are going to grow at the same pace as rents are going to grow.
Okay.
And just kind of for context, Kansas City being the #1 rent growth market in the nation, year over year from Q1 of 24 to Q1 of 25, experienced about a 5% average annual rent growth across all the multifamily units in Kansas City. So, with 3% is a pretty conservative assumption. I think Q3 24 year over year was like 7.4%. So we have a trend of rent growth. If you contrast that to some of the other kind of popular, sexy multifamily markets over the last couple of years, we're seeing a lot of negative rent growth happen in some of those markets. Some of the ones that are were most exciting 2 or 3 or 4 years ago, are -6%, -8% rent growth.
Austin is one. It's taking a little bit. We got a.
I know there's some folks here from Austin, so I don't want
James
to
is
be
James
shade.
is from Austin.
I like Austin. I like it as a city. It's just,
Oh, for sure.
yeah.
Yeah, man.
All right. We
All
got
right.
anything else, guys? I'm happy to hang on for another minute or so. If you got any other questions.
Yeah, and then anyone who joined for me, please don't hesitate to just reach out. I'd really like to have a call with everybody and just individually and just talk to you about your thoughts about it and just better understand what your investing goals are as it relates to a opportunity like this, for sure. All right. Well, if there's nothing else, Caleb, thank you so much for your time. Good to have everybody on. Thanks everyone for joining, and I will don't hesitate to reach out to me, and I'll certainly reach out to you folks after the call too. Dave, thanks for coming on camera.
Thanks
Good
so
to
much,
see you.
guys. Really good.
Yeah.
All right.
Thanks,
Appreciate it.
everybody.
Thank you, guys.
All right.
Thanks everyone. Yep.